Thank you very much. And we now go over to our third presenter today. That is Florin Ginghina. Yeah. Is that pretty accurate? You can restate your name when you come and present.
Florin Ginghina.
Okay. As we've heard, climate risk is very topical, so we're very pleased to hear about climate risk, well, the effect, climate change, and the effect on credit risk from you. Thank you very much.
Thank you, Janet. Thank you, everyone. Just a quick question. Yeah, good. So climate change and credit risk. So we'll move on to. Just a quick intro to say this paper has been made possible by the research funding from Merton, so I'm grateful for that. And now I'll move quickly just to. No, the agenda slide has gone. It's fine. Unfortunately, the agenda slide has gone off. I don't know why. The agenda will be pretty simple. So I'll start with an introduction. Then I'll cover the recent activity, publication activity with regards to climate change and credit risk. Then I'll introduce each of the topics, credit risk and climate change. Then I'll show off some results, including data analysis from publicly available climate change providers like the Bank of England. Moving to the introduction, so why credit risk? I think the motivation is that life insurers in particular, the main activity for long-term providers of insurance, particularly annuities in the UK, for example, is the investment activity. And therefore, we are concerned in an investment world with risk and rewards. The idea is that when you invest as a long-term provider of insurance, then you are subject to credit risk. And the motivation here is that credit risk, for example, in the UK is one of the largest risks on life insurance balance sheets, investing in long-term assets. The idea that we are going to discuss in later slides on credit risk, which is the Vasicek model, for those of you who are familiar with the Vasicek model, is the so-called diversification idea introduced by Markowitz back in the 1950s. I think this was already discussed in our previous presentations today. Just a warning, I also have formulas and charts. So I had the impression that the talks selected for this section were based on the number of formulas and charts on the slides. But nevertheless, I'll try to make it easy, nice and easy for everybody. And then sophisticated techniques are actually employed in building portfolios. And I think we can probably have separate talks for days and weeks talking about the Markowitz way of building portfolios, then the modern portfolio theory, and the more sophisticated current, stochastic approaches or even copula-based approaches to build investment portfolios. And then risk on climate change. This is where things get a little bit more complicated. It's because climate change is a new buzzword, and as new as it is, it's also complex in the way that data is there, is available, but it's complex, and sometimes we don't know whether it's complete. So there are a few challenges with climate change through the lenses of investment and credit risk. And this is what I'm trying to highlight in my talk today. Right, introduction to credit risk. It's only this slide, I promise, so I'm not going to have a separate, complete new talk about credit risk. Credit risk is basically comprised of two main models. We are talking about the structural models, which are based upon Merton's famous model introduced in 1974, and reduced form models, which are based upon the Poisson distribution or the idea of intensity. It's like a random process which defaults or not, as simple as that. For this particular talk today, the focus was on structural models. Just a word of caution, the Vasicek model is a manifestation of the Merton model, but in a context of a well-diversified portfolio. As I promised, there is a formula, and there will be other formulas on the next slides. Just a quick comment here. The idea of Vasicek, which I'm going to cover in the next slides, is he focused on the X, the stochastic, the random variable X in Merton's formula, which is a company's investment return. So the Vasicek structural model, building upon the Merton's idea, he pulled together the idea introduced by Markowitz, diversification, which manifests through correlation. And this is exactly what we are seeing on this slide. It's a well-known formula. The model is used by credit metrics, and I think Moody's as well. Moody's bought KMV a few years ago. KMV was put together by three people. The last one, the V in the KMV model, stands for Vasicek. It's a well-known model. It's used by American banks, for example, analyzing credit risk, and it's also in Basel. It's applied by banks in calculating credit risk under the Basel capital requirements. So it's a well-known, well-adopted model, particularly in the banking industry. As you can see, it's relatively simple. If we look at this formula, we have three main variables. We have the Z variable, which is nothing but the macroeconomic variable in his construct. Then we have the rho, which is the asset correlation. And we have the idiosyncratic risk, which is represented by variables Y. Variables Y, they are specific to each company or to each bond in a portfolio. The key result from Vasicek, so the paper he put together, he published it back in 1987. So it's a relatively old paper, but the interesting aspect is that he came up with this probability, which is conditional on the economy. This is the interesting, useful concept that we applied in our research. That dependency on macroeconomy is key to understanding the impact of climate risk through projections of economic variables on credit risk. Right. Using publicly available data with climate risk impacts over the next 20, 30, 40, 50 years, we can apply algorithmic type-based methods to come up with projected transition matrices, which was the objective of our work. The idea was to apply the Vasicek method within a context building up transition matrices using, again, a published algorithm, which is available in the paper published by these guys, Merton and Sachauer, back in 1998. The idea was that I think in the 1990s, there was a lot of activity in America, in the US, in pricing subprime bonds and loans. And there was a lot of research into this idea of coming up with methods to project or to estimate credit risk through credit ratings, for example. And that's precisely what we are using. The 6 steps shown on this slide, they are just a summary of the paper published back in 1998 by Merton and Sachauer. All the steps included here, they are well explained in the paper, so I didn't repeat them for the benefit of the presentation. Risk from climate change. Now, the idea of having a framework to project transition credit risk, credit transitions, you need to supplement it with climate data. The framework then is made possible by the idea of transmission channels, which is something that was introduced by the so-called Central Banks and Supervisors Network for Greening the Financial System, NGFS. Their work is quite fundamental. I think anybody wishing to go further in credit risk and climate change will have to look at the work that these guys are putting together. It's quite important. It's also their analyses are continuingly updated. So what you see on this slide might be already been updated by them. Why this is important, you might ask yourself. It just shows how someone can link traditional insurance risk. We have them on the right-hand side. So we have credit risk, market risk, longevity, and so on, with the original or what we believe are the originating factors for climate change, which are shown on the left-hand side. And this is where, again, one of Natalia presented, introduced the idea of projecting in the future. And then I think earlier today in the plenary session, we discussed about physical and transition risk. I think this distinction between physical and transition risk is key to any analysis of economic impact on investment portfolios. Right, but there are challenges with climate data. I think through the work we did for this paper, what we found out was that the projections sometimes are not as credible as we want them. For a 50 years projection, you might discover that you only have 2, 3, 4 point data points into the future. Sometimes some other variables, the projections are not as rich as for all the variables included. The variable selected, the selection itself, it's questionable sometimes whether it's suitable for the purpose for your purpose and so on. Right, talking about the data then, what we did the next step was, and almost this is the final step in the underlying analysis, was to look at what sources of credible data are there available. Now, we all know, I think I'm looking in the room, and I think all the continents are represented in this room. So it's really difficult to tell everybody where a credible source of data is. I'm thinking about what Tim Flannery said in the morning. He said actuaries are very good at 3 things: big data, understanding trends, and producing projections. And I think the challenge then, if you think about climate change, is exactly that. Our mindset is focused on big data, trends, and projections. What this means is that when you look at data providers, I think we have the World Bank provide some data. We have some institutions in Europe, and we also have the Bank of England. So Bank of England produced some incredibly useful scenarios back in 2021 for an exercise across the entire industry, which was called the CBEST 2021. I'm only going to discuss the grouping of their data. So what they did, they projected 4 groups of data over the next 50 years for companies to estimate the impact on their balance sheets. The data was grouped in macroeconomic, financial, transition, and physical. Now, I'm not going to talk too much about this data, is because it's a lot to analyze. It's too much data there to look at. The interesting aspect is that we found out that the macro variables are the more credible variables. Therefore, for our framework, we use 2 data sets from the macroeconomic group. Right. Now, using the Bank of England data, using the Vasicek framework, using the 6 steps that we introduced earlier, we were able to look at the data that we choose from the Bank of England and to come up with the analysis that you see on the slide. Basically, what this shows is that of the 3 scenarios that were included in the Bank of England, besides the data, they also projected 3 scenarios, which were called early action, where someone can take early action through political regulatory changes. Another one was late action, i.e. the actions that the government and legislator put together comes in a bit late, and therefore the impact of climate change starts quite early and then slows down into the future. And the third scenario, which was called no additional action, where the physical activity would be most impacted. Now, if we look at the data from the Bank of England, which was about the global GDP, under each of these scenarios, this chart shows how the scenarios are projected, and it's quite interesting. What we see here is that the late action scenario, for example, is as severe as a 1 in 200 event. Now, for us as actuaries, this is quite useful. The reason I say this is that we are used to think in terms of risk. And when we talk about risk, we like to talk about percentiles. We like to talk about 1 in 200, 1 in 100, 1 in 50. So the interesting aspect here is that it enables us as actuaries to have a conversation with someone in the investment function, for example, with people who build portfolios, credit portfolios or asset portfolios. You could tell things like, look, if you invest in this sector or this activity, which is represented by this variable, things will look really, really bad in 10 years' time. And the question is, would you like to go ahead with that, given the information that we know today? Which, again, I think goes back to one of the points that Tim Flannery was saying, that a lot of what we have today at hand is based on the actions that we take to date. But to look into the future is a big, big ask. But what can we do? We can rely on what we have now, trying to project based on the tools available to us and try to make some sense of the future. Now, another variable, which we just so happened that we selected for our exercise, was another macroeconomic variable included in the Bank of England analysis, which was crop and animal production. This is not unintentional. If you look at the data available, there are tens of variables included in the macroeconomic variables. So selecting two of them, one of them was the global GDP, which is a good representation for the Z variable in the Vasicek framework, right? It's macroeconomic. And there is a lot of institutional power when people project global GDP numbers, meaning they are more credible. But also we have crop and animal production. And I think when people talk about climate change, there are two particular sectors which come very often, like they are the sectors where people feel like the impact of climate change will be very significant. And these are real estate and agriculture. So the crop and animal production factor was a proxy for agriculture. The idea behind this was to try to represent what a portfolio projection might be if you invest assets which are exposed to agriculture risks. Right, and modeling results, and I'm getting close to finalizing. So we have put together all the tools and data that we needed for our analysis. We have the data from a respected institution, Bank of England, and we know they are liaising with other institutions in the world, so the data is as credible as it can get. We have a framework, which is the Vasicek model, which is credible again. Banks use it, they like it, regulators accept that. And we have the ability to look at the data and the results through our own lenses, which is like credit risk in terms of percentiles and so on. So the framework is there. Now, the framework that I've shown earlier, the 6 steps framework, enables us to project transition rates for all the credit ratings in the transition metrics. And the results shown on these slides are just for the A rating. A couple of points on this slide. Projecting transition rates over many years into the future may be looking simple on this slide, but it's quite complex when you get into the more granular level. The results, of course, will be linked to the severity of the underlying data. That's not unexpected. Again, I mentioned the late action scenario, where the data was showing that the projection itself was really bad, and the results confirm that. What else? You can also notice that as it was intentional in the Bank of England analysis, the baseline scenario, which was like the best estimate, was the same as late action, but then late action, because there was no regulated action to slow down climate change effects kick off, then obviously the late action completely blows out of proportion. And then another interesting aspect is that long-term, all scenarios give us consistent message. So in other words, we really need to work hard now to make sure that the impacts from climate change are somehow mitigated. Finally, what I've showed on the previous slide are the results for a well-diversified portfolio. There is, in a well-diversified portfolio, which is the underlying idea in the Vasicek framework, idiosyncratic risk goes away. For that reason, it's very hard to distinguish the impact of a particular bond, which is invested in a particular sector, like agriculture, for example. To do that, you have to use another result from the Vasicek framework and just identify that particular bond based on the variable I and project it again into the future. That separate analysis enables us to put together this slide where we can see how a particular bond with exposure to agriculture can be projected into the future through the credit ratings. Again, it's interesting, and the more keen observers of the view might have noticed that even the baseline scenario looks quite incredibly penal. All the bonds are going to default by year 2035. That's quite unexpected. If you talk to any investment manager, they will tell you that's not real. What happens here is that the Bank of England scenarios are intentionally built to look penal. So in order to observe that, obviously the first step is to analyze the data and look at the results, and then you'll be able to make judgments what adjustments you need to make in order to make the analysis more credible. The full paper, which is published and is available online, is about 20 pages. We try to include there all the ammunition that anybody who wants to go further, you have the ammunition or the tools available in the paper. So the analysis can be repeated and expanded for a full, let's say, exposure of a particular portfolio. And the results might be quite interesting. One additional analysis, and I hope it's included here. No, unfortunately it's not. There was another slide which showed the same results as shown on this slide, but with the baseline scenario shifted, as if instead of looking at the Bank of England projections, what if the GDP, for example, the global GDP will just continue to grow in line with the long-term average rate, which is about 3.8. So this is just to let you know. If you look at historical data sets for GDP, you'll find out that the long-term average is about 3.8, 3.7%. Under the Bank of England scenarios, that global GDP in the baseline scenario, it's not going as expected. So that's a question that needs to be addressed. When you apply that shift to the data, then these results look slightly better and more credible. Just to let you know, because I know the results already, under the baseline scenario, for example, if you shift it and you make it consistent with the long-term average, then a bond barely downgrades from A to BBB sometime in the 2040 something. So that's more credible, and I think an investment manager, people working on the asset manager side will tell you that's quite credible. Right. We have done lots of numerical analysis. I can tell you that. The underlying results are the results of quite a lot of time spent looking at the data and the results. But what about the conclusions? Because in the end of the day, you can look at the outputs of mathematical actuarial analysis, and the question is, so what? That so what is quite important. What we have done in this research paper was to apply something that some of us who work on this research, personally, we work on this at insurance companies. The Vasicek method is used. There are some key variables there, like the asset correlation, which can have a major impact on the results. And for anybody to look into this kind of level analysis, you need to be comfortable that you can accept a challenge by people working in other industries like the investment managers. Another learning point was that whenever you look at the climate change data, particularly projections, one unique aspect with climate change is that it's over very long periods of time. And what we discovered is that you have to make sure that the longer it goes into the future, the data points support that. So it's quite often that when you start looking at climate change data, you see 50 years projections, but there are barely, 10 data points. You are going to struggle with that, particularly in the context of investments. Because an investment manager will tell you, look, I have so many tools available that I can actually mitigate what you are saying the impacts are on this slide through, for example, rebalancing, or I can change the focus from bonds to equities or to other asset classes. So in order to give them the ammunition to have that conversation with us, you need to make sure that the analysis is flexible enough to accommodate that. So this is where I'll stop. And I've added a note here giving you the link to the underlying, the full paper. Thank you, and yeah, I'll leave it to any questions.